Investors would be prudent to buy stock in these companies that are solid winners. Each company is a fortress. CVS Health. Strong guidance and free cash flow make it attractive. Bank of America. And expanding earnings per share makes it a buy. AT&T. The company's acquisition strategies are performing strongly. Let's dive in. Here are the 3 most undervalued stocks with strong fundamentals to buy in February 2024. Welcome to Timely Investment Research. The broader indices, like the S&P 500, are turning lower, and the loom of a recession nears. The Fed attempts its soft landing. Therefore, it's more important than ever for investors to concentrate their holdings on undervalued stocks with strong fundamentals. Specifically, undervalued and otherwise speculative companies may be the first on the chopping block to be sold. On the positive side, taking a contrarian position in one's portfolio may lead to strong gains. So with this context in mind, let's examine 3 undervalued stocks with strong fundamentals to buy this month. Number 1. CVS Health. CVS Health has an integrated healthcare model, capitalizing on the growing demand for healthcare services. This year, it's going to introduce CVS Costantage, a new pharmacy reimbursement. It will more closely align pharmacy reimbursements with the quality of services provided. In light of this and the continued demand for its products, CVS Health reiterated its guidance. They expect total revenues between $351.05 to $357.3 billion, operating income of $13.06 to $14 billion, and adjusted operating income between $17.02 to $17.6 billion for fiscal year 2023. There could also be more in store for fiscal year 2024. The company forecasts total revenues of at least $366 billion and operating income of at least $15 billion. Also, they see adjusted operating income of at least $17.2 billion. The undervalued nature of CVS stock is perhaps best expressed via its P/E ratio, which is just 11.14 times earnings. This is higher than its forward measure of 8.6 times earnings, which suggests the company may be comparatively undervalued. Number 2. Bank of America. Bank of America continues to dominate the U.S. retail deposit market. The stock is undervalued due to the cyclical, expected, and inevitable wobbles of the financial sector. And this caused the bank to report mixed fourth-quarter financial results. Notably, the bank saw a 10% year-over-year decline in quarterly revenue. Also, Bank of America's shares have taken a 10.14% hit over the past year. This may underscore the belief that the financial sector could be a fertile one for a rebound. Bank of America is carefully optimistic this year, describing it as the year of the landing. Its research anticipates a continuation of disinflation, allowing central banks, including the Federal Reserve and European Central Bank, to initiate rate cuts in the second half of the year beginning in June. Analysts collectively opine that Bank of America's earnings per share will increase by 7.94% to 3.44, up from 3.19. But a turn is expected sometime around fiscal year 2026, when its earnings per share is anticipated to reach 3.94. For patient investors who can ride out the short-term headwinds, Bank of America's stock price of $33.04 makes for an attractive entry for this blue-chip dividend stock. Number 3. AT&T. AT&T is a battered dividend stock with substantial debt. However, its shares may be poised for a rebound. There have been some significant improvements in its financial performance that make me believe that it's undervalued. Namely, it reported adding 1.7 million new customers and focusing on expanding its wireless and fiber services. Looking ahead to fiscal year 2024, AT&T aims to continue this momentum. They plan to increase wireless service revenue by approximately 3% and broadband revenue by at least 7%. Furthermore, the company projects its free cash flow to be between $17 billion and $18 billion. Wall Street predicts that its stock price will increase 14.54% within the next 12 months, with its earnings per share surging by a dramatic 28.18% to 2.51. Although the company has some issues with its debt load, the upside potential is too good to ignore, which then makes it one of those undervalued stocks with strong fundamentals for investors to consider. Thanks for spending some time with us today, Timely Investment Research. We're so glad you did. If you found value in today's video, please give us a like, hit that bell icon to never miss an upload, and hey, don't forget to subscribe.